I want to start today with a visual that is honestly a little triggering, but I think everyone listening can relate to it, especially after the last 48 hours. It's a quote from one of the sources we pulled for this deep dive. Picture this. Laying on the floor, squealing, sweating profusely, scrolling on my phone for hours looking for an answer.
It sounds melodramatic.
Yeah.
But if you were staring at a trading terminal yesterday, February 9th, 2026,
Mm.
that is exactly what it felt like. It wasn't just a dip. It felt like the floor had just fallen out from under you.
It was visceral. We watched Bitcoin dump from $73,000 down to $62,000. That is an $11,000 air pocket in a single daily candle.
Yeah.
Just gone. And for people who've been in this space for a while, a 15% drop isn't new, but the speed of this one felt different.
Context is everything here. We aren't in 2017 anymore. That kind of volatility. I mean, we haven't seen that specific intensity in a long, long time. But what made this particular crash so terrifying wasn't just the size of the red candle. It was the silence.
That's the mystery we need to unpack today. Usually when crypto falls off a cliff, you know why. Immediately. You check Twitter, you check the news terminals. Oh, FTX is insolvent, or China just banned mining again.
Right. Or the SEC is suing some major exchange yesterday. Nothing. Just a massive void of information.
A total vacuum.
Zero headlines. No rumors of exchange failures. No regulatory crackdowns. Just the price collapsing. And, seasoned traders know that a vacuum of information is what breeds the most panic. When you can't see the monster, it's infinitely scarier.
So our mission today is to fill that vacuum. We aren't looking at the mainstream financial news for this because, frankly, they were still just scratching their heads. We found a really compelling theory from a small, sort of overlooked corner of the internet, an analyst named Parker, who seems to have pieced together exactly what happened.
It's a fascinating piece of forensic accounting, really. And it suggests that Bitcoin has graduated to a whole new era of risk. We're going to talk about the financialization of Bitcoin, something called cross-asset contagion, and why having these spot ETFs might mean Bitcoin now crashes for reasons that have absolutely nothing to do with crypto itself.
Okay, let's set the scene, the aftermath. We are recording this the day after the crash. The Crypto Fear and Greed Index hit its lowest level in history.
Lowest ever. And that tells you the psychological damage that was inflicted yesterday. Traders were in complete disbelief. When you see assets liquidating that fast with zero news, the immediate assumption in the market is systemic failure. Everyone thinks an exchange has been hacked or a stablecoin depegged.
Right. The bid side of the order book just evaporates. No one wants to catch a falling knife.
Nobody.
But looking at the charts today, we have bounced. Bitcoin is hovering back around $70,000. So we recovered about, $8,000 to $10,000 from the bottom. The panic is subsiding a little, but the question on everyone's mind is this a dead cat bounce?
That is the fear. Is this a temporary recovery before we go even lower? To understand that, we have to understand the mechanic of the crash. If it was a fundamental break, we probably go lower. If it was a forced liquidation, we can recover. And this is where the investigation into the invisible crash really begins.
Right. So usually you look to the big macro influencers for answers, but this time the big accounts were just, posting noise. This analyst, Parker, he pointed out something incredibly specific. He said the nature of the crash has fundamentally shifted. In the past, crashes were caused by crypto companies doing crypto things.
Exactly. Think of Three Arrows Capital, Celsius, FTX. Those were crypto-native blowups. They held crypto collateral, they took loans in crypto, and they died in crypto.
Yes. But now we're 2 years into the spot ETFs. Bitcoin is deeply integrated into the traditional stock market. And the theory here is that yesterday wasn't a crypto crash at all. It was a traditional finance crash, a TradFi blowup that just dragged Bitcoin down with it.
And that is a crucial distinction. We are looking for a suspect in the traditional financial world, not the blockchain world. And the data points to a very specific profile. A large hedge fund, likely based in Hong Kong, that completely blew up.
Blew up, as in became insolvent, margin called to zero.
Effectively, yes. And the weapon they used, or maybe the vehicle that carried the contagion, was IBIT, BlackRock's Bitcoin ETF.
Okay, let's look at the evidence for that, because the volume on IBIT yesterday was it was absolutely insane.
It was historic. IBIT saw its highest trading volume ever, nearly $11 billion. To put that in perspective, that is double its normal activity. And remember, IBIT isn't just a way to buy Bitcoin. It is now the #1 venue for Bitcoin options trading.
$11 billion in a single day. That is not retail traders panicking. That isn't you and me selling our point 0.1 Bitcoin because we got scared. That is institutional flow.
Precisely. That is get me out at any price volume. But why does the theory point to a specific hedge fund in Hong Kong? Why not just general panic selling from Wall Street?
This is where it gets into the weeds of how these funds are built, and I think this is something a lot of people miss. We assume a hedge fund just has one big pot of money.
Right, and that's rarely the case, especially for these high-risk strategies. There is a specific structure called a single asset fund.
Walk us through that. Why would a sophisticated fund, which is supposed to be all about diversification, set up a vehicle that holds only one thing? It sounds like terrible risk management.
On the surface, yeah. But it's actually a legal and strategic firewall.
Yeah.
Let's say you're a massive trading firm in Hong Kong. You want to make a huge leveraged bet on Bitcoin.
Right.
But you also have $1 billion in real estate, Apple stock, whatever. You don't want to risk those assets if your Bitcoin bet goes to zero.
So you create a sort of spin-off fund.
Exactly. You spin up a single asset fund that holds only the Bitcoin position, probably through the IBIT ETF. You are isolating margin.
Mm-hmm.
Because that trade goes horrifically wrong. If it goes to zero and the leverage kills it, the prime broker can only seize the assets in that specific fund. They can't come after your main business.
It's like a blast door on a spaceship. If the engine explodes, you seal it off so the whole ship doesn't burn.
That's the idea. But here's the catch. When that blast door closes, it closes hard. If that single asset fund gets a margin call, it has no other assets to pledge. It can't sell some Apple stock to cover the Bitcoin loss. It has to sell the Bitcoin, all of it, immediately.
And geographically, the data shows a lot of these single asset buyers for IBIT are based in Hong Kong and China.
Yes. 13F filings from previous quarters have shown a whole cluster of these structures in Asia.
Yeah.
They love the volatility, and they love the leverage you can get on ETFs.
Okay, so we have a profile, a Hong Kong-based fund, 100% all in on IBIT to isolate their risk. But a fund blowing up there shouldn't tank everything else unless there's a connection. And this is the smoking gun of the theory.
The correlations yesterday were just weird.
Weird is putting it mildly. It was a complete correlation anomaly. Yesterday, Bitcoin dropped like a rock, but so did silver, and so did gold. And usually, Bitcoiners love to claim we are an uncorrelated asset. Digital gold isn't supposed to crash just because real gold is crashing.
Well, historically, they don't move in lockstep like this.
Yeah.
Not at all. But yesterday, silver was down 20%. I just want to pause on that. 20%.
Yeah.
For a commodity like silver, that is a market-destroying move. A crash of epic proportions. It capitulated. And gold took a big hit, too.
So why does silver crashing matter for Bitcoin?
It matters because of who trades it. Asian traders, specifically in the Chinese markets, are deeply involved in gold and silver. It's a very popular speculative trade there.
I see where this is going. If the same people own both.
That brings us to the liquidation thesis. Imagine you are this hedge fund manager. You are levered up to the eyeballs on a hard money thesis. You own silver, gold, and Bitcoin via IBIT. Suddenly, silver crashes 20%.
Your whole portfolio value just plummets.
And your prime broker calls. They don't ask nicely. They say, you are below your maintenance margin. Send us $50 million in the next hour, or we liquidate you.
And if they are all in, they don't have the cash.
Correct. So what does the broker do? They don't care about your long-term beliefs. They're a risk desk. They hit the sell all button. They sell your gold, they sell your silver, and they dump your entire IBIT position onto the market instantly.
That explains the $11 billion in volume, and it explains why everything crashed at the same time. It wasn't the market suddenly hating Bitcoin and silver. It was one entity being forced to puke up everything they owned.
It fits the pattern perfectly. And there's another specific detail, an asset called DFDV.
I saw that in the notes. DFDV, that's a ticker symbol, right? What is it?
It's a thematic ETF, often a proxy for high beta tech or Asian market exposure. It's a niche product, not something your average retail investor holds. But it's popular with these specific aggressive funds.
And how did DFDV do?
It had its worst single day ever, just collapsed. When you see unrelated assets, Bitcoin, silver, and this niche tech ETF all having their worst day ever at the exact same minute, you are not looking at a shift in macro sentiment. You're looking at a forced liquidation of a specific portfolio. It's the fingerprint of a single massive whale dying.
It's like forensic accounting. You're looking at the corpse of the market and working backward. And the analyst, Parker, he actually reconstructed the timeline. He traces this back way before yesterday.
This is the part that really validates the theory for me. A blow-up of this size doesn't happen overnight. It's a slow bleed that ends in a hemorrhage. He points to two specific dates, October 10th and January 15th.
Let's start with October 10th. This is what we're calling the origin story of the crash.
Right. If you recall, back in October, Bitcoin was flying high. We were near all-time highs, trading around $122,000. Sentiment was just euphoric.
I remember that. Everyone was calling for 150K by Christmas.
Yep. And then on October 10th, out of nowhere, we saw this sudden violent drop to about 106,000. It absolutely destroyed the altcoin market. It felt random at the time. But Parker's theory is that this drop is when the hole was blown in this hedge fund's balance sheet.
So they took a massive loss in October. Maybe a bad leverage bet went wrong.
Likely. They took a hit that put them underwater. Now, a rational person takes their loss and goes home. But in the world of high-stakes hedge funds, you have gambler's ruin. When a fund takes a massive hit but isn't dead yet, they don't close up shop, they double down.
They try to trade their way out of the hole.
Exactly. They likely added leverage, rotated into even riskier assets, trying to win it back on the next bounce. They were trading for their lives between October and January.
But the market never gave them that bounce they needed.
It just chopped around. Which brings us to January 15th, the death knell.
What makes January 15th so important?
Bitcoin was trading around 100,000. Parker noted that aggressive selling began precisely at midnight Hong Kong time.
There's the geography again. Midnight Hong Kong time. That's right at their market open.
It's a very specific time to start dumping unless you are facing redemption requests. January 15th is often a deadline for quarterly redemptions. Investors want their money back. The fund is already in a hole from October. They can't pay the investors.
So they have to start selling assets just to pay people out.
And that starts the death spiral. They sell Bitcoin to pay investors, which lowers the price, which lowers the value of their remaining collateral. Then they get desperate. They jump into silver, hoping for a quick win. Silver crashes. Now they're completely trapped.
And yesterday, February 9th, was just the final flush. The broker took over and just hit the sell all button because the math didn't work anymore.
That is the theory. And honestly, it's the only one that really fits all the data points. The geography, the timing, the weird asset correlations, and the record-breaking ETF volume.
So let's pivot to the so what for everyone listening, because most people listening aren't running billion-dollar hedge funds. They're holding Bitcoin in a cold wallet. This sounds like big league problems that are suddenly becoming our problems.
It absolutely is, and that is the double-edged sword of financialization. We spent years clamoring for a spot ETF. We said, we want the institutions, we want Wall Street. Well, we got them.
And we got their baggage.
We imported their systemic risk. ETFs introduced macro and derivative risks to Bitcoin. Just didn't exist before. It's no longer just about the blockchain or the halving cycle. It's about carry trades and cross-asset contagion. Bitcoin can now crash because a fund in Hong Kong made a bad bet on silver.
That is frustrating, isn't it? You do your research, you believe in the tech, and then you lose 15% of your net worth in an hour because some guy in a suit made a bad call on a totally different commodity.
It is frustrating, but there is a silver lining, pun intended.
I was hoping you'd say that, because right now it sounds like we just volunteered to be collateral damage for Wall Street. What's the good news?
The good news is that this was a flow issue, not a fundamental issue.
Write that down. What's the difference?
A fundamental issue is if the Bitcoin network got hacked, or a critical bug was found, or quantum computing broke the encryption. That breaks the thesis. That destroys value permanently.
Right.
A flow issue is just forced selling. Someone had to sell, not because the asset is bad, but because they were broke. The asset Bitcoin is performing exactly as it should. Blocks are still being produced. The network is secure.
So the price drop is kind of artificial.
It's a temporary dislocation. Once the insolvent whale is done selling their coins, the pressure evaporates.
Yeah.
Instantly. There is no more seller. The market realizes, wait, Bitcoin is still Bitcoin. And the price recovers. This is why markets often bounce back so quickly after these liquidation events.
And we are seeing that. Support is building at that $69,000 to $70,000 level.
Which, poetically, was the cycle high from the last bull market. It was the ceiling back then. Now it's becoming the floor. That's a very healthy technical sign. It shows real demand is waiting to scoop up those coins.
I should mention one of our sources, Tyler, actually said he bought the dip heavily yesterday. He viewed that extreme fear, that squealing on the floor feeling, as a massive counter signal.
It's the classic Buffett advice. Be greedy when others are fearful. But it takes a remarkably strong stomach to do that when you don't know why the price is dropping. When you're buying into a black hole of information like that, that is peak conviction.
Now, we have been presenting this as a theory. It's a very convincing theory, but it is still a theory. Is there any way to prove it, or is this just speculation?
There is a way to prove it, but we have to play the waiting game. The traditional financial system moves at the speed of, I don't know, fax machines compared to
Be
crypto.
like, can we just look up who sold?
Not immediately. Institutional holdings are reported in what are called 13F filings. These are quarterly reports filed with the SEC.
How long is the lag on that?
They have 45 days after the quarter ends to report. So if this fund went to zero yesterday, in February, we're in Q1, we won't see the smoking gun, a giant IBIT dropping a zero on a fund's books, until roughly May.
So we have to wait 3 months to know for sure if Parker was right.
Unfortunately, yes. That is the opacity of the traditional system. Ironically, if this were on-chain, in DeFi, we would know the wallet address instantly. We could watch the liquidation live. But because it's wrapped in an ETF, we're back to quarterly paper filings.
That's a great point. We traded the transparency of the blockchain for the liquidity of Wall Street.
And this opacity is a cost.
So to wrap this up, what we likely witnessed yesterday wasn't the end of crypto. It wasn't a ban. It wasn't a hack. It was a traditional finance hedge fund blowing up their leverage on a toxic cocktail of gold, silver, and Bitcoin ETFs.
That sums it up. The market panicked because it couldn't see the cause. But the cause appears to be isolated to a specific entity. Once that flush is done, the market can breathe again.
And Bitcoin has graduated to the big leagues, which means it now suffers from big league problems like hedge fund insolvencies.
It's part of the maturity of the asset class. The volatility is still here, but the drivers of that volatility are changing. We have to learn to watch different signals now. We have to watch silver futures, not just the Bitcoin hash rate.
I want to leave everyone with one final thought, a loose thread that is still bothering me about this whole timeline.
What's that?
October 10th.
Ah, the origin.
We know that yesterday was the liquidation, and we know October 10th was when the hole was blown in their balance sheet, dropping Bitcoin from 122,000. But we still don't know what caused that initial drop on October 10th.
That is the lingering mystery, isn't it? We found the body, but we haven't found the bullet from the first shot.
Exactly. If that trigger whatever knocked the first domino over back in October, if that's still out there, could it happen again?
Something to think about.
Thanks